The following podcast was recorded on Wednesday, April 5th, 2023, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim answers the question, is a credit crunch coming? Jim, we've spoken a lot about the banking industry, and we keep returning to the issue of depositors withdrawing funds from banks for higher yielding alternatives. What's the latest on the deposit outflows?
So the last podcast we did, we talked all about what was going on with deposit outflows, and I would encourage you, if you hadn't heard it, to go back and listen to that. But the summary of that is very quickly. I'm holding up my phone. We all now have phones right now, and all of these phones have 120 million of us have downloaded mobile banking apps. So if we go to the first chart, what I wanted to spell, this is other deposits. So this doesn't include jumbo time deposits or jumbo CDs. This includes like savings accounts and checking accounts. And the bottom chart shows the 5-week flow. The outflow began months ago. It did not start with the banking crisis. It culminated in the banking crisis. And the reason the outflow started is we pushed everybody to mobile apps. And by pushing them to mobile apps, we've made the friction of moving your money very easy. And they've been doing it, and that's what squeezed the banks to cause the problem. Not that the banks' problems popped up out of the blue and everybody decided to run to the banks. So if we go to the next chart, this shows you in orange, the average deposit rate for a savings account or a checking account in the United States is still 0.5%, and the average money market fund is 4.5%. That 400 basis point spread is worth it to reach into my pocket. If I reach into my pocket, or if I have $250,000 in a Chase money market account or Chase savings account, which I checked this morning is still yielding 1 basis point, 1 basis point. I reach into my pocket, grab my mobile app, log on to my Chase account, go to Chase Securities or JP Morgan Securities and put it in a money market fund that's yielding $470, $14,000 a year in 3 minutes of work. The rational thing to do is that. The rational thing to expect until this orange line and blue line converge, and they're not, is that this deposit outflow will continue week after week after week. Not a hemorrhage that another bank will fail, but it'll just bleed out and bleed out and bleed out. I talked about this in the last podcast in more detail. Again, encourage you to go listen to that one to talk more about what's going on with deposits.
And next, let's talk about loans. Where do loans come from?
So the next chart, there's $21 trillion of banking assets in the United States, 21 trillion. 6.8 of that is in small and regional banks. That is collectively larger than JP Morgan and Bank of America combined. Banks, small and regional banks, 70% of their assets are loans. In large banks, it's 30%. The other half is securities. So large banks buy securities, small banks hand out loans. So even though the small banks are about 28, 29% of all banking assets, so red line shows they're 70% of commercial real estate loans. They are 55% of all real estate loans, and they're 38% of residential real estate loans or a mortgage, or a home builder getting a loan to build a home. They're 34% of commercial industrial loans. Remember, they're 28% of all assets, but they have a higher weighting of more of loans relative to their assets, and they're 24% of consumer loans. Collectively, they are very big in terms of the economy. If they have lost the visibility on their deposits, and that's why I was talking about holding on my phone again, is that when we make this mistake with technology all the time, here's a new technology, push everybody to mobile apps. We could get rid of branches. We could cut down overhead. We can increase our profitability. No, you're also changing your business model and you're changing deposit behavior. You didn't see it because we were stuck with zero interest rates for years and years and years. But now that interest rates have gone up a lot and you've opened a giant spread, you can see it. If you've lost deposit visibility and you don't know what's going on, the ability to keep all of these percentages at these levels, and notice all these lines go up, that the regional banks as a percentage of all loans is increasing their shares. This is where companies go to get loans, the restaurant to expand, the apartment building to get built, working capital. Remember, the majority of people in the United States work for a company of less than 100 employees. We work for a company of less than 100 employees. Those companies have specialized needs. They are met by the 4,000 regional banks. They specialize in certain things. If you're a commercial real estate developer in a city, you know which banks to go to. If you're a restaurant that needs working capital, you know which other banks to go to, and they're all regional banks. Usually the large banks, the Chases and the Bank of Americas of the world, they have branches, but those branches usually have wealth managers in those branches. They're there to help you manage your money as a deposit, not necessarily, I mean, it's not exclusive. They do hand out loans, but they're really pushing to help manage people with their deposits because they invest in securities. They're not, stocking up with bankers that are experts in commercial real estate in that market or in restaurants in that market to hand out loans. That's why we use regional banks. That's why we have them. So if deposit visibility is lost, and again, the last podcast, I talked a lot more about that, then the ability to keep these lines going, up, meaning lending, is going to come into question. That's a very nice way of saying a credit crunch. Yes, I would like to give you your loan, but the bank is now impaired on its ability to hand out loans, not your credit is what is the problem at place. So if we jump to the next chart, as far as deposit visibility goes, this is also from the H8 report. That's the consolidated report on bank assets and liabilities that is becoming very popular to look at. That comes out on Friday afternoon. This shows you total bank credit. How much loans do all the banks in the United States hand out? The top panel shows $12.15 trillion of loans and leases have been handed out by banks. The middle panel shows you how much it's changed. It fell 20.36 billion in the week ending on the 22nd. We'll get the data for the week ending the 29th on Friday. That is the lowest number since June of 21. That is almost a 2.5-year low, or excuse me, a 2-year low as well. On a percentage basis, it's also the same. There was a big pullback. If you've lost deposit visibility and you're constantly getting outflows because the world is going to money market funds, and that is where money market funds is leaving the bank, you should expect loans to drop. Now, it did for 1 week. Now, that's 1 week, but it's what we would have expected. We'll have to see in the subsequent weeks whether or not that follows through. And if we go to the final chart in this section, at least, this expands the list from just loans and leases and now includes securities, which is called bank credit, the bigger issue of bank credit. So that fell $70 billion or $69.7 billion. 20 of it was loans. The other 50 of it or so was securities. That's the biggest 1 week contraction since 2008, or on a percentage basis in the bottom panel since 2010. I want to repeat it again for emphasis. If you've lost deposit visibility, this is what you would expect to happen. It happened 1 week so far. So I don't want to announce that we're all doomed, but let's see if this continues. And if we see this happening over and over again, then we've got the idea for the potential of a credit crunch. Last thought on this subject. What is a bank? You and I and everybody else, we would think of a bank as a warehouse where we keep our money. I put my money in the bank. They give me an interest rate. It's safe in the bank. I don't lose it. It doesn't get caught. I don't put it in a box under my bed and it gets caught in fires or something like that. But the Federal Reserve and bankers and businesses, it's a credit intermediary mechanism. It gets money from people that have it to money to people that do have it. And I wouldn't be going too forward by saying the Fed views that lending more importantly than the safety of your money. They are uber concerned about that banks continue to lend and then keep your money safe. But lend, lend, lend. This is why they won't allow non-lending banks. People have tried to come up with these ideas of non-lending banks where they hold all the money at the Fed, get an interest rate from the Fed, pass it along to you, take a little bit off for their costs, and it would be basically the safest type of bank. And the Fed won't give them a banking charter because they don't lend. So if we continue to see this non-lending because of a loss of deposit visibility, this is going to be a big problem for the economy. We would see along the way this idea that